Yes, I'm Brian Levin. I'll be playing President Kacha Lakota.
I'm Shalini Singh. I'll be playing Governor Yellen.
I'm Dan Wolf. I'll be playing Ben Bernanke.
I'm Max Lithgow. I'll be playing Governor Dudley.
I'm Lucas Zaldon. I'll be playing Governor Honig.
Judges?
Present.
I'm Alex Albrecht. I'm the Executive Director of the Eastern Economic Association, and I was a high school Fit Challenge participant in 1996. So there's hope for you.
Good morning. My name is Roy Webb. I'm a senior economist with the Federal Reserve Bank of Richmond.
Hi, I'm Stacy Tevlin. I'm the Chief of Macroeconomic Analysis here at the board.
When you're ready, let me know, and I'll start the 20-minute time clock. I have a 2-minute warning card and a please finish card for you as well. All right?
Thank you.
So tell me when you're ready.
Good morning, everyone. Before we continue, I'd like to thank the Fed staff for providing the data and analysis in the Green Book, which is always a useful resource for us in our meetings. We continue to see improvement in global economic activities in the beginning of a fragile recovery, although the pace of the recovery appears less vigorous than originally anticipated. While real GDP increased at an annual rate of 3.7% in Q1, 1.7% in Q2, and 2.5% in Q3, recovery in labor markets continues to be weak. Consumer caution is to be expected, given persistent high unemployment, reflected by the fact that households have been saving more. While credit conditions have improved since the depths of the crisis, business investment has only increased slightly. In spite of highly accommodating monetary policy, inflation expectations for the short term remain low, justifying stimulative actions by the Fed in an effort to preserve the dual mandate of price stability and full employment. The Fed must establish a framework to ensure that economic conditions are conducive for the handoff to private final demand to take place, while controlling inflationary pressures in the medium to long term.
Yeah, one key aspect in this handoff is the labor market scenario. In spite of continued stimulative measures by the Fed and the government, the unemployment rate remains elevated at 9.6%. One worrisome factor stunting the labor market is that the modest increase in private hiring is overwhelmed by massive reductions in government staffing.
Look, I agree that the employment picture is bleak, but at the same time, some of this negative news is actually positive. For example, some of the factors that are restraining growth in employment include increasing labor productivity and increasing hours worked per employee. This is a sign of long-term recovery in and of itself. Additionally, the recent uptick in unemployment can be largely attributed to improved outlook, as previously discouraged workers are regaining confidence and beginning to re-enter the labor force.
Tom, this may be true, but at the same time, the number of workers who are not currently in the labor force but do want a job has also increased. Furthermore, the labor force participation rate has decreased by 1.5 percentage points since the onset of the recession. Couple this with some of the bleak predictions for unemployment, and the picture looks even weaker.
The largely weak labor market conditions continue to restrain growth in both household income and spending. In fact, since stabilizing in mid-2009, real household spending has only increased between 1 to 2% annually. As well, the Michigan Consumer Sentiment Index declined 0.7% in October, although it still remains well above its trough reached in November of 2008.
Consumer credit and revolving debt outstanding have declined over the past year. As well, the Fed survey of bank lending practices shows that most banks' lending standards remain tight.
The household savings rate remains elevated at 5.7% of disposable income, pointing to improving household balance sheets. Home values, a principal component of household wealth, still remain generally depressed. The 20-city Case-Shiller index is about 28% below its 2007 peak. Going forward, improved affordability, the result of record low mortgage rates and lower house prices, should increase the demand for housing. However, the overhang of foreclosures and vacancies are likely to weigh on residential investment and home values for some time.
Yeah, I think it's also important to note that uncertainty with regards to the legal status of securitized mortgages is exacerbating this overhang of foreclosures and vacant homes.
Yeah, a natural question to now ask is that if consumers continue to save more than during the previous business cycle, where the required growth in capacity utilization will come from? If the economy continues to rebalance, the answer is likely to be exports and investment demand.
Well, the increase in exports is likely to be driven by the increasing competitiveness of the U.S. manufacturing sector, given the depreciation of the U.S. dollar versus the currencies of low-cost manufacturing centers in Southeast Asia and Latin America. However, we must remain mindful of the international ramifications of our recent round of quantitative easing, as several nations such as Brazil have begun to enact measures to prevent the appreciation of their currencies, a series of events that some have dubbed the currency war.
Moving on, business investment has remained constrained by relatively weak corporate expenditures. However, the ISM PMI index, which captures the outlook of purchasing managers, has recovered substantially since crisis levels. Additionally, business investment in equipment and software rose substantially over the first half of the year.
But Tom, the ISM PMI index has stagnated in recent months, and the business investment growth that we are talking about mainly represents spending that was delayed during the crisis, not necessarily ongoing sales demand. Moreover, a large part of the corporate profits can be attributed to cost-cutting measures and increased productivity, not necessarily top-line sales growth. The most important point probably to note here is that the rate of growth of corporate profits has declined by 70% since Q1 over the last year.
Oh, come on. Corporate profits are still rising at a 12% annualized rate. I mean, that's pretty fast. Furthermore, once broader economic conditions improve, you're going to see corporations start to channel large cash holdings into real investments. As such, I think the business investment picture can best be summarized by a lack of demand as opposed to a lack of balance sheet capacity.
Domestic capital markets are roughly flat on the year as investors debate the vigor of the emerging economic recovery. Looking at equities, the S&P 500 is up 6.5% on the year. The improved stability in equity markets is evident in the dramatic drop in the CBOE volatility index to near its long-term average of about 21.
On a related note, in the credit markets, firms with direct access to capital markets have had far greater success in obtaining financing than small and medium-sized firms that depend on bank loans for funding. As well, the LIBOR-OIS spread, which is a key measure of confidence in the interbank lending market, remains well-behaved at 10 basis points since reaching a peak of 364 basis points in 2008.
Despite improvements in credit and equity markets, continued fears about the European sovereign debt crisis present a potential source of uncertainty going forward. Although the fears that surrounded the European debt crisis in the spring and summer had receded following the implementation of the EU bailout mechanism, Ireland's recent rescue and developments in the U.S. domestic municipal bond market present a potential sources of uncertainty going forward. For instance, in light of California's recent $14 billion issuance, a major municipal bond index recorded its greatest increase in yield in 18 months. As such, the municipal bond market merits our attention in the coming months and years.
Yeah, I think it's also important to consider the dramatic shifts in the regulatory environment over the past year, which have basically changed the nature of financial markets and are expected to continue to do so over the next few years. For instance, the recently agreed upon Basel III Accord is expected to gradually increase bank capital and liquidity requirements to levels commensurate with the need to maintain systemic stability in the face of a financial crisis by 2019. As well, the Dodd-Frank Act's incentives to centrally clear many over-the-counter exchange derivatives is expected to reduce the fragility of the financial system as a result of broad reductions in counterparty credit risk and increased margin requirements.
As the chairman mentioned earlier, low inflation conditions may allow for continued easing to improve labor market conditions without compromising the dual mandate. While the annualized one-month PCE inflation rate has ranged between negative 1.5% and 2.8% over the past year, more stable measures of core inflation, such as the PCE excluding food and energy, and the trimmed mean PCE have ranged between 0.1% and 1.5%. Additionally, the October year-on-year change in the core CPI was only 0.6%, its lowest level since 1957. These numbers are below level, which many at the Fed think is most compatible with its dual mandate.
Additionally, with the 10-year tip spread at approximately 2%, the market expected inflation to remain well-behaved, at least over the medium term. However, we must approach this data with caution, given that the market for inflation-indexed securities is heavily influenced by varying liquidity and inflation premia. Nevertheless, these expectations do fall in line with a survey of professional forecasters.
Before delving into a discussion of policy, we should examine further our forecasts of unemployment. Relevant factors include future employment expectations, inflationary expectations, structural versus cyclical components, trends in labor force participation, and transfer payments. The problem comes from assessing which of these factors are more important and when.
We use an ARMA model to forecast unemployment, including factors such as past unemployment and inflation data, as well as an index of employment expectations constructed from JOLTS data. We use an Akaike information criterion to determine the order of our ARMA model.
Our forecasts shown here in blue varied based upon the inclusion of expectations constructed from JOLTS data, which seemed overly optimistic. While the core of our forecasts do fall in line with a variety of professional forecasters, it is important to note a number of modeling issues that arise from the current economic scenario.
Yeah, for example, three big issues are limited JOLTS data, which only goes back 10 years, potentially large shifts in the natural rate of unemployment, and then fundamental shifts in the nature of monetary policy at the zero lower bound.
An interesting thing to note in the labor markets is that the modest increase in aggregate U.S. labor demand as reflected by the increase in job vacancies, is not really matched by a corresponding increase in hiring. As well, the San Francisco Fed estimates that the Beveridge curve in 2010 has shifted rightwards by around 2.5% as compared to 2009. Now, this shift might imply an increase in structural unemployment in the economy because of reasons like reduced geographic mobility of workers and also the mismatch in skill sets between the available workers and the employer requirements.
Indeed, the latest Beige Book cites anecdotal evidence supporting the claim that some of the jobs available are of a more technical nature, and as such, the skill set of, say, unemployed construction workers doesn't meet the requirements of these openings. In addition, many unemployed workers are underwater on their mortgages, making it difficult for them to move to find a new job.
According to the San Francisco Fed, the NAIRU is estimated to increase by about half the horizontal shift of the Beveridge curve, implying a temporary increase in NAIRU of about 1.25 percentage points as a result of this recession.
That being said, I think it's prudent to point out the impact of the extension of unemployment benefits from 6 months to nearly 2 years. This subsidy of unemployment has increased both the average duration of unemployment and the unemployment rate substantially as workers spend time acquiring the skills needed to find a job and find jobs which better match their skill set. However, with the expiration of these unemployment benefits coming soon for many, it is likely that we will begin to see employment growth shortly.
Unless, of course, the exhaustion of these benefits means a decline in consumption, which can inhibit or even reverse any such growth.
While I feel that we have a firm grasp on the complexity of the present economic conditions, our job at the Fed is to implement policies to maintain, or when appropriate, shift the economy onto a course consistent with our dual mandate.
Yet, traditional Taylor rule actually recommends a negative Fed funds target rate right now. But we should really approach this with caution given the potentially large shifts in the natural rate of unemployment, which can be hard to pin down precisely.
Yeah, but Tom, recent research at the San Francisco Fed looks at a modified version of the Taylor rule that looks at changes in unemployment rather than deviations from potentially ill-defined natural rates. And this Taylor rule also recommends negative rates, suggesting further stimulus.
Okay, sure, but we should also look at the monetary base, which has nearly doubled over the past 2 years as the Fed expanded its balance sheet through policies of quantitative easing. Though unusually slow bank credit growth means that broader measures of money have risen by much less, resumption of historical credit dynamics could lead to a dangerous spurt in inflation. As such, I think we really need to approach our Taylor rule with caution.
In light of the current economic conditions and in agreement with the implicit assumption of the Taylor rule, we voted in favor of enacting a second round of quantitative easing at our last meeting. Though viewed as unconventional by many members of the public, the idea of creating excess reserves to purchase long-term securities and lower yields is fairly comparable to typical open market operations.
According to research by New York Fed staff members, the enacted volume of QE2 was equivalent to lowering the federal funds rate by about 75 basis points. Fed purchases reduce the net supply of certain long-term assets and thus lead investors to rebalance their portfolios in favor of other assets in search of better yields, the portfolio balance channel. As a result, our purchases of treasuries should reduce their yields and those of long-term corporate bonds and asset-backed securities with similar duration and liquidity characteristics.
Yeah, with all that in mind, let's look at how markets responded to our announcement of QE2. Since we announced QE2, 10-year treasury yields have actually increased by 25 basis points. This seemingly counterintuitive reaction can be largely attributed to the fact that markets had already priced in substantially larger purchases at longer end of the yield curve. Additionally, the 10 to 30-year term premium has increased by about 4 basis points.
In light of such market reactions, I think we must consider modifications to our purchases because we want to have the desired effect on the yield curve and broader economic indicators. Also, it is important to point out the reaction of the equity markets to QE2 because the associated boost in net wealth is an important channel through which purchases translate into broader economic growth.
In light of these mixed market signals, in the coming months, we should begin to look at the transmission of our policy through money and credit growth, as well as underlying economic factors like employment, inflation, investment, and GDP growth to see if our purchases are having the desired stimulative effects or if we might need to increase them.
You know, the BLS just announced that there was a 150,000 person increase in non-farm payroll employment in October. That's the largest increase since May when census employment was boosting the figures. Given that we already have recovery underway, I think we should really be hesitant to attribute further recovery to quantitative easing. Furthermore, if QE2 stimulates inflation, we're going to need to wind down our large MBS portfolio. The $1 trillion worth of agency MBS that we currently own is going to be extremely difficult to sell, considering that it represents about 21% of total aggregate outstanding agency MBS.
But Tom, in response to your concerns, we already have We already have the tools to tighten policy appropriately when inflationary pressures do return. These include increasing the federal funds rate, increasing the interest rate on excess reserves, selling balance sheet assets, and of course, reverse repos. Now, the Fed has already begun successful experimentation with reverse repos on a small scale.
But all inflation concerns aside, it's apparent at this point that purchases still haven't moved the meter. 10-year inflation expectations, as approximated by the tip spread, went down by 5 basis points after the announcement. An increase in the volume of planned purchases to remedy this might seem like too much of an abrupt policy correction and could compromise the credibility of the Fed. So instead, I think we should consider increasing the weighted average maturity of our purchases to push down real interest rates across the curve.
Yeah, this would have the additional benefit of amplifying the net wealth effect that we talked about because of the greater interest rate sensitivity of longer-term securities and shorter-term securities. So I think we could consider increasing our purchases of 10 and 30-year securities to increase the weighted average maturity of our portfolio to around 8 years rather than the 5 to 6 originally planned.
However, such a policy change would be tantamount to broadcasting a mistake in our last policy change, and as such could dangerously compromise the credibility of the Fed.
On a related note, effective communication with the public is vital to the success of our actions, particularly when we're at the zero lower bound. One of the key additions to the Fed's arsenal in the past 20 years has been better communication with the public, including more frequent publishing of FOMC statements and minutes.
I agree. For example, communication in the form of specifying a flexible inflation target of, say, 2% is expected to yield lower real interest rates, which might be what the economy requires right now. Also, this has the effect of anchoring long-term expectations, long-term inflation expectations, which further stimulates strategic business decisions and investment by the markets.
Yeah, but I wonder how much this differs from current policy. Markets have long assumed an implicit 2% target. And furthermore, in our recent FOMC minutes, we started publishing longer run expectations of inflation from Fed governors and Fed presidents. These are consistently between 1.5 and 2%. It doesn't get much clearer than this without unnecessarily compromising policy flexibility.
Another way to clarify our communication would to give more guidance on the future path of the federal funds rates.
But Ben, we've already anchored lower short-term rates with the terminology in an extended period of time.
Charlie Evans was telling me that people keep asking him, what does extended period of time stand for? How long is that actually? And he keeps saying, 6 months. But he's been saying this for over a year.
Well, if we look at the Fed fund rates futures market, then we see that the market expects the Fed funds rate to remain where it is at least for the next 10 months. While we could change our communication to anchor these short-term rates even further, this could again compromise our credibility as the Fed if economic conditions begin to change. Thus, I think our current communication policy is certainly appropriate.
In light of the lack of sufficient new economic data or dramatic changes in market conditions since the announcement of QE2, I propose that we maintain the target Fed funds rate at 0 to 25 basis points for an extended period of time, and leave unchanged the current planned Treasury purchasing schedule. All in favor?
Aye.
Aye. All opposed?
Although I don't have a vote and I'm generally opposed to QE2, the decision has been made and we must follow through with it.
QE2 is a bargain with the devil.
I take it you're opposed then.
With a result of 3 in favor and 1 opposed, the continuation of the large-scale asset purchasing program has been approved. Instructions to continue enactment of the program will be relayed to the Open Market Operations Desk at the New York Fed.
I'll be sure to keep an eye on them.
Now let's get some lunch.
Well, thank you for that presentation. You certainly covered a lot of material. Obviously worked very hard putting things together, and here it comes right at the end of the semester with lots of stuff going on, so really appreciate your attention and effort in this. Let me start with one thing you mentioned earlier in the presentation when you talked on the importance of expectations of inflation, and then later you mentioned a couple of measures, the tip spread, and very briefly mentioned the survey of professional forecasters. Are those the only measures of expected inflation we should pay attention to?
If we look at the Philadelphia Fed, they published the Livingston Index, which is again a conglomeration of other expectations. I think it's also important though to put emphasis, you talked about the tip spread. We have all these professional forecasters, but at the end of the day, that's only the opinions of 1 or 2 or maybe a team of people. If we look at more market inflation expectations, things like the tip spread, although as we mentioned in the presentation, it's not a perfect estimate because liquidity can change and people's expectations of inflation, how important that is, can change. But if we look at things like that, we're looking at the opinion of millions of people who are going out and expressing their views. So while there are other things that can show inflation expectations, like the Livingston Index and other things, we do prefer, as our team members, to look at the inflation expectations generated from the tip spread.
Yeah, if we want to look at the market expectations of inflation, there's also, it's not really used much and we definitely didn't use it for this one, but looking at the spread of the inflation swaps is also it's a relevant measure to measure inflation expectations. So for instance, during QE1 and right after QE1, the spread showed a significant spike, but it has been relatively subtle following QE2, at least till now.
And the last branch would be through economic modeling. You have different kinds of models that kind of try to estimate what the reasonable expectations for inflation would be, and then you can assume that markets follow these. You either have like adaptive expectations is one way of modeling them, or forward-looking structural expectations, or some combination of the two, actually. So.
Okay, conspicuous by its absence are survey measures. Do you find them at all useful?
So the one that we mentioned was the survey of Philadelphia forecasters, right? So that's
okay. That's the survey of current forecasters. Are you at all familiar with the University of Michigan?
The Consumer Sentiment Survey.
Yes.
So expectations that arrive from consumer sentiment surveys have been shown to perhaps provide a little bit of statistical importance or additional statistical significance in macroeconomic models, but sometimes people question.
Let me be clear, I'm talking about a measure of inflation expectations, not a measure of consumer sentiment that might predict consumer spending. Okay.
Excuse me. One thing you mentioned in the presentation, which I thought was interesting, was the Basel III. You mentioned it, I think. And you indicated that it would be something that would support stability going forward. Do you think it could also have an effect on the sort of general macroeconomy? Do you think it has any role in slowing the economy going forward?
I think it has a twofold effect. I think it has a positive impact in that if you look at banks and you talk to senior bankers, for instance, the Wall Street Journal CEO summit here in Washington, D.C. a week ago Monday, you saw Bob Diamond from Barclays say the biggest thing that, in his opinion, is allowing the economy not to go forward is that banks don't know the rules. They don't know how much money I need to hold and when they're really going to implement the Basel Accords. And because there are accords, it doesn't necessarily mean they're laws. So even though they've been agreed upon, and Ben Bernanke went to Basel and they all agreed upon these things, banks still really don't know what the rules are going to look like and when they're going to be implemented. And as such, they can't go today and say, we're going to increase our loan portfolio by X amount. Once it becomes more clear how those laws are going to turn into actual policies in the U.S., I think it certainly will have a positive impact because banks will know the rules they have to play by. As we've seen, banks really just need to know how they can perform in order to go out and actually give loans. Until they know that, we will continue to see this drag on the economy because they'll be overly conservative. The second thing is how individual countries will go ahead and actually implement the Basel Accords. For instance, we saw them increase the Tier 1 capital ratio to 7 or 8%. Switzerland, when they actually went to implement these, made it more like 19% because they determined the way that they treated contingent capital. So I think the Basel III Accords, while it will present a way for banks to begin to stimulate the economy, it's still unclear how they'll be implemented and what that timeline looks like.
One other question is that a lot of the sort of business of maturity and liquidity transformation has been taken over by the shadow banking system recently, including hedge funds and other types of firms and conduits, and a lot of these credit transmission mechanisms that take money market funds and turn them into longer-term investments, usually in asset-backed securities or other types of loans, are backed by liquidity guarantees from the regulated banking system. And the introduction of sort of liquidity requirements like the 30 days of cash on hand rule and things like that that are in Basel III, haven't really been tried before. Screwing down capital requirements, we have some experience with those. We don't have a lot of experience with liquidity requirements, and so it'll be interesting to see whether that really damages the ability of the shadow banking system to provide some liquidity transformation, and if so, it might be tough to replace that because the shadow banking system won't be able to do it, and the regulated banking system won't be able to do it.
Another question I have is, I was thinking to myself as you were presenting that this must have been a very interesting time to be doing this since there's been so much scrutiny on the Fed over the last 6 months or a year. One thing that I've seen in the press that caught my attention was so a few people making new calls for return to the gold standard. I want to know what you guys think of the gold standard, its pros and cons, and whether that idea of returning to that has any merit.
Yeah, so the gold standard was viewed as a relatively stable system to kind of introduce stability in the exchange rates across the world. But I think while it definitely did a good job at maintaining stability during the post-war period, pre-war period, I'm sorry, I think it has potential drawbacks in the form of like the countries can choose to leave the gold standard when they want, and then even once they get back, we saw this a lot with countries like Argentina, for instance. They chose to leave it and then come back, and even when they came back, they might not choose to come back at the original parity. So that really induces a lot of imbalances in the global economy, and also since everything was pegged to gold, everything really depended on discoveries in gold and technology, which increased the supply of gold. And there's like, obviously capital inflows of gold led to the increase in money supply. Another negative is that the monetary policy is kind of not very free to do what it wants to do, because you obviously have that constraint going forward. So while it was a good system to like anchor imbalances in the global economy, I think in the long run it was more of a constraint, like a binding constraint, than a stabilizing factor.
And if we were, on the gold standard today or prior to the financial crisis, it's likely that the Fed might not have been able to take as many dramatic actions that it has to help the macroeconomy, most notably quantitative easing, to be able to that rapidly increase the money supply. That flexibility is sort of sacrificed.
Thank you. One other thing I want to ask about, you mentioned the ISM survey, you showed it, and said that it's recovered substantially. But some of the other more regional indicators of manufacturing have been mixed, so in particular the Empire State Index plummeted last month. So I'm wondering how you would weight these regional Fed indexes versus the overall ISM.
Well, I think that the way that the ISM PMI index is constructed gives us a pretty good overall national view. Obviously, if you have certain concentrated issues, you even see this like in Michigan, for instance. If you took a sentiment index of people in Detroit, you would think that basically the country's coming to the end. With nearly 20% unemployment in Detroit, conditions in New York and certain pockets could be possible. However, given that the ISM PMI index is a survey of over 400 people who are actually in charge of the purchasing decisions across the manufacturing industry, and they break it down to 4 things. Do you think that you'll increase your purchases next month? Do you think that your receipts will increase next month? Do you expect to hire more employees next month? Not only are you forecasting a large amount of people, you're forecasting them on many different points. So while I think that obviously you will have mixed results from certain regional areas, I think a national survey like the ISM PMI index, because the way it's constructed in the broad view, is more indicative of what's really going on in the national economy.
Yeah, I think it also falls in line with the basic principle guiding the FOMC and the Fed and the structure of the Federal Reserve in whole, because you have regional Fed presidents representing the entire United States, and then you have the Board of Governors representing kind of the national interest of the United States. So I think it's more of like, for example, Kansas City, the Kansas City Fed showed a significant boost in manufacturing growth all across and almost every sector. So I think it's like it boils down to the basic principle of FOMC that you have to like weight every region individually, and plus when you decide on a policy, you can obviously make flexible changes to like suit maybe a region economy.
Thank you.
So I'm a little confused. So the point of QE2, right, is to lower rates so firms can borrow and then make investment, right? But then you said that corporate profits and cash holdings of firms is very high and growing. So if lowering the cost of investment would cause them to invest more, but they already have the money, so is QE2 then unnecessary?
I think we need to look at the broader picture of QE2. Like, while it's true that businesses and banks have the cash, but as we talked about the uncertainty surrounding the Basel III, like because of uncertainties in the environment, they're not very willing to lend it out. QE2 has broader ramifications. For instance, it's a major way of the Fed signaling to the economy that we are going to do all it takes to keep the recovery going. We're going to go ahead and do additional purchases in case the economy needs it. So Bernanke talked about Chairman Bernanke talked about this in his paper about zero monetary policy at the zero level bound, where he talked about how important communication actually is. So I think QE2 is important in the sense that it's a very credible mode of communication with respect to the Fed.
Another thing to note is that if we were sort of seeing a resurgence in investment and credit growth, the divergence between the M2 and the monetary base wouldn't be so dramatic. And that big gap shows that a lot of the monetary easing that we've done so far hasn't been transmitted through credit expansion. And so, companies may have a lot of cash on their balance sheets, but clearly credit conditions overall aren't strong enough to be bolstering investment.
And also, firms that have been able, we mentioned this in our presentation as well, that firms that have been able to access the capital markets have had easier time obtaining financing than smaller companies, which just rely on banks for lending. So still increasing the reserves for those banks could potentially stimulate lending to smaller companies, which has a lot to do with employment as well.
Just on a side note, even though this might not be like a primary objective of QE2, the effect on the dollar and depreciation and the corresponding boost in exports is certainly something to look at going forward.
You talked a lot about communication. So if you look at the minutes recently, like about a year and a half ago, it said that it was a meeting of the FOMC. Then I think it was March last year, they said it's now a combined meeting of the Board of Governors and the FOMC. Any idea what the Fed might be trying to communicate by changing the language at the beginning of the minutes? I know it's a nitpicky question, but I was wondering if you had an idea.
I think it could be a multitude of things. Obviously, there's no correct answer to this. I guess the people in this room who are sitting here at the meeting may have the right answer to that. But just from hearing this question, my guess would be, has something to do along the lines of what my teammate mentioned, was that by joining the Board of Governors who are representing these national interests with the FOMC, which is made up of local governors, it may give more credibility to the fact that they're trying to balance this national versus local, as opposed to just the FOMC, which is made up of people who are coming from their own city or state in representing those national interests. Because people may say, well, I'm from a state and I don't really have somebody who sits on the FOMC because I don't have a Fed bank. Well, if you look at the Board of Governors, it's almost like your representatives on a national level and the FOMC is your representatives on a local level. I think it may give more credence to the public to believe that policy is really being crafted by people who have both local and national interests in mind.
Another possibility is that as the Board of Governors has become, sort of regulatory involvement and more direct involvement with financial institutions has become a more prominent part of the Fed's role over the last few years with the crisis, and the Board of Governors being sort of more primarily responsible for regulation, it might be to try to send a message that monetary policy is kind of on the same page as the policy decisions that led to bailouts and now and the opening and closing of different credit facilities and all those actions that happened during the crisis.
Let me switch hats and go to my college professor hat for a second. Now that you've participated in the College Fed Challenge, what's the most important thing you've learned?
I think I always really liked monetary policy, but the Fed Challenge definitely kind of unravel the immense potential that monetary policy has. And one thing that I mean, this is like a personal opinion, but I think monetary policy is more like an art than a science. Especially given current economic conditions, it's really hard to pin down what you want to do, why you want to do it, and QE2, I was really surprised by all the backlash the Fed had to face. So I think it's a very interesting field to be in. A lot of thought and a lot of non-economic thought going in as well.
Okay, it's finished. Thank you very much. I would